I'm Joe Anthony. I'm originally from the Venturers cohort of Stanford lead program. So it's been like a couple of years since I finished my lead program. I'm still active in the community. So I'm also a founding partner at LISA, as Edward mentioned. I'll begin by thanking all the panelists for taking time to be with us and making yourself available. And we look forward to a great discussion today. And I would also like to thank all the audience members who have joined us from different parts of the world. So we definitely value your time commitment to this and deciding to participate in the session live. And as Edward mentioned again, the panel discussion that we have today is part of a series of PodiumX panel discussions, interviews, and speaker sessions that have been put together by Lisa, primarily for the benefit of startup founders and Stanford, especially within the Stanford lead and MSX ecosystem. And this, in fact, is the second time we are doing a discussion on the topic of corporate venturing. We did one last year, and it was quite well received. In today's session, we'll be probing a little deeper into the corporate venturing and examining it from at least 3 different perspectives. So essentially, I want to cover off, the perspective of an investor and how an investor is looking at the market today. And then we also want to cover the founder's perspective in terms of what they should be thinking about in today's world, especially if they are planning to engage a CVC, which is corporate venture capitalist, of course. And also we want to cover off from a corporate leader's perspective, if as a corporate leader, if you are interested in setting up a corporate venture arm, what might be some of the best practices, what might be some of the pitfalls that you would want to avoid. You want to kind of cover off from these 3 perspectives in general. Bit of housekeeping, before we begin, so as Edward mentioned, everyone will be on mute. So try to be on mute unless you're speaking, unless you are one of the panelists. And also you would have the opportunity to ask questions along the way, but do that in the chat window. And we would address these questions towards the end of the session. It'll be great when you're asking a question, if you can give us a bit of a context around, who you are and why you are asking that question, why that's relevant for you. That will help us to get the best answer out of the panelists, as well as, if required, have a discussion around your question as well. So with that housekeeping bit out of the way, I guess we're all set to get started. I think the first order of business is basically to give an opportunity for the panelists to introduce themselves properly. So to that end, we would go around to all panelists, but to begin with, let's perhaps go to Christopher Chu from Samsung Catalyst Fund. Christopher, tell us about who you are, and tell us about your corporate venture, venture arm, and what you do.
Yes, well, hey, thank you very much. Thank you very much for inviting us. It's a pleasure speaking here. I'm Christopher Chu. I'm with the Samsung Catalyst Fund, Managing Director. We are based in Menlo Park, just right across the campus, by the way, from Stanford. Samsung Catalyst Fund, we're one of the investment arms of Samsung Electronics. We invest in core technologies. We are multi-stage in terms of areas that stagings of where we invest. We do seed, and we go a little bit further up the stack. My background is I've been in venture capital since 1995, so cover all different areas. But thanks again.
Thank you, Christopher. I'd now request Stephan Baral from Porsche Ventures to give a brief introduction about yourself.
Yeah, sure. Thanks, Joe. And also thanks for having me. Pleasure to be here. My name is Stephan. I'm working for Porsche Ventures and Porsche Digital. So it's one company then, but two different approaches. Porsche Digital is essentially the digital competence center for Porsche to work on and scale digital business models ourselves, essentially on behalf of Porsche. And Porsche Ventures is the venture arm of Porsche, investing into early and growth stage companies, primarily focused on things that are relevant for Porsche at the end, right? Like mobility and digital lifestyle, and also emerging technologies. And excited to be here and speak with you guys further in the next hour. And been in automotive all my life, actually. Started in Spain, in Barcelona, beautiful location, at SEAT, which is a Spanish car company. Then moved to Volkswagen, then to Porsche, and landed here in Palo Alto again in a very nice location in the Bay Area.
Amazing. It's a great, looks like a great career path. Next, let's go to Kasper from BMW i Ventures.
Yeah, sure, happy to. Kasper Sage, I'm a partner at BMW i Ventures. We have been around for roughly 10 years, first 5 years as a typical corporate venture arm. Since 2016, that's when I joined. We're an independent fund with one LP. So all the money comes from BMW, but we are a typical VC setup, meaning all the decision making is in the partnership. Headquarters is in Mountain View and in the city. We have roughly 55 portfolio companies, invest in early to mid stage. Usually I would say Series A is probably the best time to engage with us. We've done a couple of seed deals, but it's usually a little bit of a stretch unless we have something that the market doesn't know, which informs our investment decision. Yeah, I mean, typical like a VC, we like to lead deals. We have roughly 30 board involvements. We are at the end of our fund 1 and are going to be announcing our fund 2 soon. We invest in everything, so hardware, software in the space of transportation, manufacturing, and climate tech. So I think that's new. The climate tech piece, that's something that originally we didn't put that much emphasis on, but recently has become more and more focus for us. Excited to be here.
Thank you, Kasper. Next, let's go to Mark Crawford from Stanley Ventures. Hi, Mark.
Hi, I'm Mark Crawford. I am a managing director at Stanley Ventures, which is the CVC arm of Stanley Black & Decker. Yes, it is the tool company, is our core business. My function and why I'm running the West Coast office and why they started the venturing practice here is Stanley is in an interesting position, extreme market saturation, and there is a finite TAM associated with hand tools with little differentiation. So we are using corporate venturing to find new pathways. We typically invest in the early stage, seed, Series A, early B. I will say we're full life cycle investors because we're investing from the balance sheet. We've been around and we're stood up, gosh, 3.5 years ago and have deployed about $80 million in capital in 35, 36 portcos.
Awesome. Thank you. Thanks, everyone, for a great round of introductions. So that sets us up nicely for this discussion. So I think the first question that I would like to ask and begin to kickstart the discussion is to clarify a little bit about because a lot of so it's kind of a newish concept for some people, although it's been there for a while. So let's kind of look at where corporate venturing falls within the spectrum of venture capital and private equity investors and everything that's out there. Where do you guys actually fit in? Since I finished on Mark, how about Mark? Can you take a lead on this, responding to that question, and perhaps we can bring in other panelists as well.
Sure. So not to offend any of my venture capital brethren here, but there is a prevailing scuttlebutt around the ecosystem that CVC arms should not be participating in the asset class. They are liquidity options, and I would say that is in all cases not true. Where we like to fit is I like to see it as, in fact, our money may be a little bit greener. Certainly my investment practice, I like to bring certainly the capital, and we participate in deals very much aligned to venture capital terms that you would see on any firm on Sand Hill Road. But I'd like to say what I think we're able to offer is some of the auxiliary services that traditional VC shops can't bring. One of my goals, besides the deployment of capital, is to bring external innovation internally. And one of the differentiations with my practices is I'm able to bring to bear the $17 billion public company and some of the resources that are involved with that. And what I mean by that is once you are a Stanley Black & Decker Portco, you have the opportunity to get into, say, our manufacturing process, and we will pay NRE, but we will also be pilot customers as well as reference customers. We're willing to make the introduction to our various suppliers. One of the other things I think is so great about my particular practice is as we're bringing that external innovation or that Portco internally, part of my goal is to learn and, you know, a number of other things, fill that M&A pipeline. So I used to work for Intel Capital. So very much like Intel Capital, one of our mandates is to date before we marry. So it really allows us to take a look under the hood, to use since we have a lot of automotive guys here, under the hood before I actually plow in full bore on an acquisition. So I just wanted to sort of dispel that myth. I will also say I understand where that histrionics comes from. You know, over the course of the years, there's been a lot of CV firms that have plowed aggressively in the asset class and quickly retreated. I think in the maturation of the CVC venturing ecosystem, we've matured, and no longer do we make those mistakes that were made in the past.
Awesome, great response. I really love that analogy of, you know, date before you marry. Okay, so how about any others in the panel? You know, do you want to chime in? Do you want to add any other perspectives on top of what Mark has already offered?
Yeah, I can probably briefly add to that. I think in general, CVC is fairly complex in my opinion, right? It really depends on the CVC, to be honest, at the end. There are so many different approaches in the industry. And I think as a founder, it's really important to understand what the strategy of the CVC is that you're talking to, right? Because there might be companies that purely focus on a strategic value and driving M&A. There might be other companies that are really like VCs, right? At the end, traditional VCs. So I think it's fairly complex to understand the CVC environment, and recommendation for everyone before you engage, I guess, with anyone. It's one of the most important decisions of a founder, right? Of a startup in general, like what kind of investor do you want to have on your cap table? Who do you want to have in your board that helps you grow your company? First of all, understand like the vision and the strategy and the goals of the people that you are talking to. And that, in my opinion, doesn't count only for CVC. It's actually pretty similar for VC as well.
Yeah, I would agree with Stephan on that one as well. Samsung venture capital, we've been in a venture for probably the last 20 years, and we've been around, and our basis for investments is not M&A based. We are here to create synergies with the startups and ourselves, where 1 + 1 = 3, regardless of that is. I don't think, actually, the funniest thing is if you look at our portfolio, there is probably a very low correlation of our investments with our own acquisition. We're really here to create value regardless of any strategic decision from acquisition. But we are a strategic fund. We want to make sure that our vision is also aligned with the investments that we do have, and that we can help foster their market wherewithal, and in line with where Samsung also wants to go. So,
and let me clear up. So that's just one of the pillars here. So M&A is one of the pillars. I think we're very aligned with Samsung. There is a learning aspect of it. There's an aspect to fill in gaps in our product roadmap. There's also, I view my practice as a mirror to the market. Some of the BU GMs that I support, they're focused on their 24, 36-month P&L, and the sprinkling a little venture dust allows them to see what's going to creep and potentially eat their lunch.
I'm happy to add a little bit to that. So I mean, from our perspective, and obviously we are more in the camp of like trying to be a VC plus value add. So from our perspective, CVC done right is really like adding value on top of a VC process. And what that means is like you gotta be as fast as a VC, you gotta be able to structure deals like a VC. And you also gotta be able to execute those like a VC. Yeah. And then what comes basically after you have done the deal. So I mean, two things. During diligence, obviously being part of a larger conglomerate allows you to do diligence that often VCs can't do, right? From like real deep technical stuff, like analyzing a LiDAR sensor, or like, you know, getting data on a new radar sensor, or like some sensor fusion data, like this kind of stuff. As a VC is super hard to do. Now there are firms who do like hard tech and have their own engineers / experts in the network. But for most typical central road VCs, it's almost impossible to do this kind of stuff in a timely and effective and, you know, good manner. Now, after the investment is done, obviously there's this whole process of like business development and making sure that you can actually get value add to the company. Yeah, and I think one thing that is really, really important here is alignment of incentives, right? So the thing is, it's very different if you have a CVC investing in your company whose primary target is defined by the corporation that they work for. So if they are on the payroll of that company, then like their whole mindset is, hey, how do I add value to my mothership? Now, it really should be, how do I add value to the company that I invested in? Yeah, so having financial incentives, having carry is super, super critical, because ultimately, if you don't have that, you get into like dimensions where CVCs start negotiating ROFRs into your deal, or they have exclusivity, or like, you know, for this market, we want to have access to this kind of stuff. And then it gets very hairy and difficult. And quite frankly, I've seen deals where like, if that kind of stuff happens, like VCs will jump the gun and be like, okay, I'm out. Like, this is not a good deal. And the other thing, and then I'm going to stop, is like, careful with valuations. Yeah, there are certain CVCs around the table who are not financially incentivized, so they don't care really about the return of their investment, because they're getting their return from like the business side of things. Now, in those cases, you always think that you might have another round that you need to finance. So what really hurts is if you have like a high valuation, looks great because you don't have much dilution, awesome, but then nobody might wanna invest like on the back burner of that in the next round. And then you get into like, you know, down rounds and terrible stuff. So just be mindful of that.
Awesome. That's really great round of responses on that question. And I think we've pretty much nailed that with different perspectives coming through. Let's kind of shift our focus on a little bit on today's context, you know, especially, you know, top of everyone's mind is COVID and crisis that COVID has brought in. That pretty much every industry in the world, across the world, is affected. So how has this changed your investment thesis? You know, how has this impacted you? Do you see this as a crisis unfolding, or do you see opportunity within this crisis? You know, if we can just have a quick discussion on that, that would be really awesome. How about Stephan? Would you like to, you know?
Yeah, sure.
Started, take the lead on this. Yeah.
Yeah, happy to do that. Thank you. I think different perspectives, right? One thing that for me has been super exciting to see is, and in my opinion, it would have unbelievable prior to COVID. We even closed several deals in the last year without even seeing the founding team in person, right? Like that's something which was for me super eye-opening. I wouldn't have believed in that before. For sure, it's always preferred to meet people in person, but it works also without it. That was super eye-opening to me personally. How we look at companies, I think for us, it didn't change a lot because even prior to COVID, we primarily invested in software companies, which most of them haven't been that much impacted, luckily, by the pandemic. But I think one thing that we definitely do if we look at companies and look at their traction, like we are a little bit sensitive in looking what their performance has been prior to COVID and then during COVID, right? Because there might be business models out there that probably are not sustainable after COVID because they probably are taking a certain opportunity that just exists right now. I think that's something that we are sensitive with, but overall, personally, I feel like it's a huge opportunity for the market because especially big enterprises like Porsche or other companies, COVID has been an accelerator for a lot of digital innovation within the company, right? Even in enterprise SaaS, but also in other digital touch points with customers. Customers are also our customers are more used to go online to see things. So I think huge opportunity that is out there, and luckily also a lot of companies and founders that are taking that opportunity and driving successful businesses even during those times.
Awesome. Any other perspectives? So I'm hearing positive things from Stephan. It seems more like a opportunity, built into the crisis.
Yeah,
is there other?
Yeah, I might just comment a little bit. Because of the COVID situation, I would agree with Stephan. You would have thought that it would have changed a little bit more on how we did deals, but we use Zoom or whatever, use WebEx or whatever very effectively. And I think it's, at least it's very Silicon Valley like that. I think the entrepreneurs, the VCs, everyone is pretty much adopted to that very quickly. So it'd be interesting to see as we come off of the COVID crisis, are we really going to be going back into the office full time and things like that? Because the efficiencies were actually were pretty good. That being said, in terms of investments and stuff like that, I think during COVID, it really did show a lot about the importance of core infrastructure. And as you can see now, we have a semiconductor shortage going on because of all of the devices and systems and such that you really need in place to serve a more mobile workforce out there. So I think that kind of benefits a lot of folks that are investing in those spaces going forward.
Yeah, a little bit to echo what Stephan had said on the digitalization piece. So one thing that I think became very clear, I mean, particularly in e-commerce, but also for auto guys like Porsche and BMWs, before it was kind of like a nice to have like digital offerings and like a website and being able to potentially buy or book a test drive online. Now it's like for dealerships who don't have an answer or a solution to be able to buy a car online, they're not going to be around anymore. So the thing is, like, all of a sudden it switched from like nice to have to must have. And this kind of stuff is not going to go away. Like tomorrow, like if people started buying cars online, this is only the beginning. Like at some point, why would you even have to have a dealership except for, like service and other potential touch points? But I think there's actually a huge opportunity for companies in that space. And we have seen it in a couple of portfolio companies of ours.
Great.
And let me amplify what everyone said. The model has changed, and Stanley Black & Decker, we did close a bunch of deals and didn't meet the founders personally. I found from our existing portcos, it really showed the mettle of some of the founders, those that were able to navigate this well, and those that not so well and didn't perform as well. This is a people business, and usually these things succeed or fail by the management team. So it gave certainly me some perspective going forward when the anticipated follow-on round is inevitably going to happen, I get a good idea how the management team's going to respond, not only in good times and bad times, and certainly we'll take that into investment consideration on that next time that the hat is passed around.
Maybe just one more comment. So what I thought is interesting to see is like, just given that now founders can actually pitch VCs in like back to back, which usually would have involved them like, you know, flying from that side of the country to the other. It actually creates a pretty competitive dynamic in certain deals, yeah, where like usually you would have, you know, a week more or maybe 2 weeks more until you can actually submit a term sheet. All of a sudden you have guys who are like, even advertising now, we don't have a Mondays meeting anymore. We can sign a term sheet in like 24 hours. You're like, okay. Like, and this was not possible before this kind of like channel. Yeah. So it's interesting whether this is gonna fundamentally change how quickly deals get done.
That is so interesting to hear, you know, all these different perspectives and, you know, how things have changed. You know, in most instances, it seems like it's a very positive change as well. Less travel, more business, and greater velocity, you know, is what I'm hearing. Just maybe, you know, just time to kind of move on to founder-related questions, you know, especially for the large community of founders that we have here in our ecosystem. You know, we'd like to understand, you know, what are you investing in today? So given our scenario and, you know, where the world is at, and, you know, what are the kind of organizations that, you know, companies, the startups that you are investing in? How about we start with Kasper this time and go around? I would like to hear from all the panelists as well for this question. So Kasper.
Sure. Yeah, I mean, it's pretty broad in the sense, like, again, as I said, we're interested in stuff in the supply chain, in manufacturing, and, you know, digital car sales, robotics, all of it. The thing is, like, having such a broad scope obviously comes with being a little more flexible on like the typical profile that we're looking at. If you have, like, let's say an enterprise SaaS focused VC, they usually have like pretty clear metrics and cookie cutter sort of scheme that you have to have in terms of like traction before they will talk to you. For us, again, it really depends on what we're looking at. If you have, let's say, a semiconductor company that is gonna go like automotive qualification process and then ultimately will make it into the vehicles, that's a very different sort of set of KPIs that you're looking at versus, let's say, a fintech play that we invested in that enables dealerships to sell cars online. So it's very, you know, very different. This makes it interesting for us because we have all these like different sort of spectrums. I would generally say, I mean, at least for our fund, I mean, there are other CVCs who might look at companies a little earlier. But in my experience, if you really want to get the benefit of working with a large corporation and understanding how the ecosystem works, this is usually something for a little bit later in your life cycle. Just if you have, like, even if you're the best founding team on this planet, if you, in the moment that you engage with a large corporation, they're gonna ask for all kinds of stuff. And this means like you have to have people that can actually respond to that, because otherwise, if you start a conversation and then you stop, then that's not good style. So there's not gonna lead anywhere. So the thing is, like, ultimately you need to have some traction and some ability to fulfill if you want to get the most out of that kind of relationship.
Sounds great, Kasper. Can I request Stephan to go next? And I'm keen to also understand, you know, I looked at your portfolios and I see that you've got some common investments as well. I mean, you've invested in the same startups. So I'm just keen to hear how that works.
How did this happen?
Exactly. Your parent organizations are competitors, I would imagine. So how is this working for you guys? If you can comment,
yeah,
great.
Yes, I probably start with the first question and then answer the second one. So first of all, I echo what actually also Kasper said. I think we're also pretty broad, focusing on mobility, but going a little bit beyond that. So if you look at our portfolio, you essentially see also companies there, like for example, Rally, which is a fintech company that actually allows you to buy shares into collectible assets, right? Which is super exciting in my opinion. It's a New York-based company. So now the question is, why did we actually invest into such a company? Porsche is all about passion at the end, right? And our brand purpose is actually driven by dreams. That's why we are also saying we are investing into founders that dare to build their dreams essentially. And Rally is spot on in that case, right? They are allowing people to own a piece of something that they are passionate about, that they probably could never buy like completely. That was our investment thesis there. But then you see other companies like Urgently, to like come to your second part of the question. Urgently is actually it's a roadside assistant a company, the Uber for roadside assistance, so to say, right? Kasper can talk better about them because he knows them longer. But I think what Kasper said before, I think like CVCs, they should have the mindset to not ask for exclusivity, not be afraid to invest together with competitors and things like that, right? And I think that's definitely our mindset, and something that is relevant for BMW I Ventures, so for another car company, could definitely also be relevant for us. So that's why we are also sometimes co-investing in that company, to make one example. Hope that answers both of your questions.
Yeah, it does, and it's really great to see that kind of mindset in action. So sometimes it's mindset, when people say about mindsets, mostly talk and less of action behind it, but it's great to see that in action in the case of Porsche and BMW I Ventures. So let me just go on to Mark next. Mark, what kind of companies are you looking to invest in today's scenario?
So unlike some of the panel, our themes are very well defined, and we're a CVC that's in the process of maturing. So keep that in mind when I answer this question. So the themes and thesis that we're pursuing are very much aligned to what SBD does very, very well. We are the leaders within our particular vertical in manufacturing. We want to maintain that leadership. Part of doing that is a deep dive into I 4.0 companies. So that's one of the things we're exploring. The natural adjacencies for the SKUs on Home Depot and Lowe's shelves, and where our products are primarily used on construction sites. So prop tech and contact are something that we're heavily in. Most people don't know as well that Stanley Black & Decker has a security unit. And out here in Silicon Valley, when I said usually it's cyber security, but this is actually physical security. So you more than likely, if you go to your local convenience store or you go to the airport, the front end, the actual doors, and the back end, all of the black ops stops, facial recognition and those type of things, gunshot detection, stuff you wouldn't normally see, is either us or a competitor. So those type of security plays. Also, something else that's very adjacent, where we're really investing is what we want is very strategic, as someone mentioned, but I'm really pushing towards product refresh and margin expansion. So any of those things that if you're a gearhead kind of person, a Bluetooth enabled torque wrench, or we make heavy equipment attachments, augers, impact hammers, those type of things. A sensor technology that is enabled to identify lithium, for example, out of a bucket pole. So adjacencies to Stanley Black & Decker, where there's a natural fit, where once again we can add value.
That's great to hear, Mark. What I'm hearing is a lot of emphasis on adjacency, perhaps a strategic fit, that can be mutually exploited.
That's right. That's absolutely correct.
Yeah. Awesome. Okay, let's move on to Christopher then. Christopher, what are you investing in these days?
Yeah, well, initially us too, we're very broad in terms of where we invested. We invested in companies on the IoT side early on. You probably know the company Ring. We did a lot of stuff also in automotive, and we're very happy also to have invested with BMW I Ventures and another company called Mapillary. We look at digital health and healthcare companies as they relate to Samsung's wearable projects. We do a lot of stuff on the sensor side. Currently we're really looking and dwelling a little bit deeper into cloud, data center, AI, accelerators, processors, and platforms. We're fortunate to invest in a number of companies on that side, GraphCore, Sambanova, actually from homegrown at Stanford, Habana, and another company called Blaze. So all of those companies we believe are really important for just general core infrastructure as enterprises grow up, as hyperscalers grow even larger, and as data sets get enormously large. So it's a little bit of a play on Samsung's emphasis in building out that infrastructure for the next generation database economies.
Sounds great, Christopher. Just had a quick question to you. So Samsung Catalyst Fund, how is it connected to Samsung Venture?
Right.
I think there's another arm as well, right? So,
of course, yeah, absolutely. So Samsung Ventures has been around since, 2000. So a very, very large capitalized fund. They are very closely related to our business units. So think of them as really more bottoms-up approach, which is really, really important for success of Samsung, right? So they would be looking at companies that would be identified by Samsung early on and says, hey, this is the perfect company for us to really engage because they are addressing this particular need. Okay, so that's really Samsung Ventures. It's our sister fund and we trade a lot of deals with them. We were set up about 8 years ago from a little different strategy to go top down. And the DNA of our team is very much related to folks on institutional investors on Santa. I was an investor for a little bit in some of these venture funds. Top down, so what does that mean? That basically means that we are thinking about the thesis aboard. What's going to be important for Samsung 3, 4, 5 years out there from our relationships with folks here at this panel, folks on the corporate side across the board, folks from other VCs, entrepreneurs, great universities like Stanford, and generating those theses and saying, hey, this is what we see is coming down the pipeline. Please engage with companies like the ones I had mentioned earlier, and moving forward with that to work with our business units and these great entrepreneurial teams to really take advantage of those opportunities.
Awesome. Thank you for clarifying that, Christopher. Just another question that I had, from a founder's perspective. So if I were to be pitching to one of you, or a CVC, how would that pitch be different from, say if I'm pitching to a regular financial VC? And what should my ask be? So typically when I go to a VC, I ask for money, perhaps connections, perhaps, to build up my, to scale my startup. So how is a CVC pitch going to be different? So can I ask Christopher to take the lead on that? So if I were to be pitching to you, what would you be looking for, and what should my ask include?
Yeah, I think we're fortunate. A lot of the entrepreneurs that do come to our doorsteps, they're pretty aware of that it is a CVC, and Samsung. Fortunately, we do have a lot of different opportunities for engagement. So my advice to a founder would be, I think we had mentioned this earlier, would be know the strategic fund that you're pitching to. Maybe do a little bit more of due diligence. Some CVCs have different cultures than others, and they may be looking for different. Some may be more financialists, they may be more strategic, but just kind of know that. And since you're already in the door chatting with the likes of the automotive companies we have, or Samsung or such, you would already kind of know what do I need from you guys that can go beyond what I would be finding from another venture capitalist. In many of these cases, these entrepreneurs already have a financial backer, so they're actually looking beyond that, and they're just trying to increase their reach, the value add that the investors can bring. So they're going to ask, hey, in Samsung's case, if it's a semiconductor company, they'll ask about, what are the foundry services available? If it's a sensor company, they may ask, okay, well, how might you be able to help me get into, your Samsung wearable company, wearable product, right? Things along that line. So yeah, just kind of know that strategic that you're meeting with, and know exactly some of the levers that where they can be helpful. So that's a pretty simple answer there.
Yeah, it's great to know, Christopher. So let me then move to other panelists. If you would like to chime in and add to what Christopher has said. Is there anything else that you'd like?
Yeah, happy to add. I think I can 100% confirm what Christopher said, actually. But I think it's not even just for CVCs, a good advice for founders, right? I think you always should know why you are talking to a specific fund and how you think that fund can add value to you as a startup. Because if you don't know that, then I would, as an investor, get suspicious. Like, are you just running around finding money? So you should know what you want. And I think our mindset also at Porsche Ventures is that we want to actually only invest into startups where we also can contribute value to them, right? I think also coming back to a point that I think Kasper made at the beginning, if you are an investor that just wants to get something out of the company for your own purposes, that's one story. But I think as an investor, you really have to think about the company first, about the entrepreneurs first, and really honestly think about what value can you as an investor add to that company. And because of that, we always, or I at least always ask the question, why are you coming to us? What do you expect from us? What's the value that we can add to your company? But then also, I think what also Christopher said, you should also think about why that specific industry might be relevant for your startup, right? That's probably a bit different than talking to an institutional VC, where it's more about like market size and kind of really big industry. But for us, at least at the end, it's helpful to understand how your solution, your business model, your technology could actually be applied somehow within automotive, right? It doesn't have to be limited to automotive, but what's your reason why you are even talking to an automotive backed venture fund?
Sure. Thanks, Stephan. I think, we kind of stretch, for time. So we just would move to the next question, which is a very direct one. If one of our founders want to, seek investment from one of you guys, what is the approach, right? So let me just quickly go around the panel to ask, that question. So let's start with Mark. Mark, if I'm looking for a CVC investment from you, how would I approach you, and what's the pathway for me?
So preferably a warm introduction. I've been in the asset class an awful long time, so I too, I think it was Christopher, I got in the early 2000s as a baby, as an associate. It's a rarity that I know it's the dream that we see a business plan or deck come across the transom, and we're so in love with it and enamored, and we immediately write a check. So that warm introduction, as with all VC shops, it's well received, and I'm more likely to open that email or take that call. I also want to add and amplify what the other panelists have said. I think really, really important, and some of the mistakes of before you approach the CVC, be very wary if that CVC wants you to optimize to them as opposed to the ecosystem, right? You need to be that entrepreneur. You need to be thinking liquidity options and why Stanley Ventures or Porsche Ventures or Samsung is the right partner for you at that particular time. There's certainly, depending on the stage, and I think most people said they were rather early or growth stage, there's going to be additional follow-on capital. And you need to understand, once you have them on that CVC on your cap table, what's the ecosystem going to say? Is as I said, I spent many years at Intel Capital, and it was sometimes challenging to get a Samsung, a Qualcomm, and NVIDIA to be one of those liquidity options, because they always thought that it was that the portco was optimized to CPUs as opposed to, in NVIDIA's case, GPUs, right? And in some cases it was, but really sort of think that through before you sort of take that money. So circling back, I did want to add that. So circling back, that warm introduction is key for me. I will say I also have the nature of my investment practice. There's a level of comfort with my IC in a syndicate network. We can de-risk that investment, and you can bring me a bunch of other interested parties. I don't mind leading. I don't mind leading that group. I don't mind following that group. But to get someone else to believe is really, really important for me.
Thank you, Mark. I would like others to chime in and provide your perspectives as well. So how about Stephan? Would you like to go next?
Yeah, not much to add, I think. Definitely warm introduction is always helpful, but I think the easiest way to reach out to people is LinkedIn, right?
Sure.
So nothing more to add.
Awesome, great. And Kasper?
Yeah, I mean, I've had situations where people sent me a deck and I looked at it and it's actually interesting. So I wouldn't necessarily exclude it, but just be aware when you do that, that it has to be really targeted, right? Like, so if somebody sends me a deck about, I don't know, the next fridge technology, great, awesome, but not for me, right? But if somebody comes with, let's say, a new, like at a specific stage, and they're looking for something very specific, and they have a very good understanding of where they think this can fit inside the automotive ecosystem or BMW, then this can be very relevant. Yeah. So, but yeah, I mean, I should echo, like the normal standard process is you get somebody who knows us to make an intro. That's the best way.
Excellent.
Yeah, I would just say also, hopefully we will find you. You know, that's the thing. So that you've done your work as well. You've networked with all the relevant folks in the industry that you are looking at, right? I mean, so like a healthcare company, you should be talking to Kaiser Permanente, or if you're in automotive, you'll be talking to BMW, and this, because even the CVCs, we all talk as well. So it's very quick, it's very easy. I see many of the automotive VCs as friends. So, for us, happy to get those introductions and such, but just really network again with your customer base or your potential customer base, because most likely that healthcare company or automotive company or AI company will have friends already in the VC area, and it's always easy for us to go and say, oh, okay, we will reach out to you, as to you always trying to reach out for us as well, because there's a lot of emails we do get, and it's such a pleasure when we actually have a chance to touch base externally with you guys.
Great responses across the board, and so on that note, we would definitely like to extend our invitation to the showcases and the demo days that we have as part of either this cohort or any subsequent ones, so that you're across the kind of portfolio of founders that we have. And just switching gears a little bit, given that we've got only 7 minutes left, bit on the corporate side of the world. I don't see any audience questions, so if you have any serious questions that you would like to ask, please feel free to type in. But in the absence of that, let me just ask a question which might be relevant to a corporate leader who's trying to establish a venture arm for their parent organization. What advice would you give? What best practices and what pitfalls should they avoid? Based on your experiences. I see all of you are pretty successful in running these corporate venture arm, and so keen to hear what advice you would have. to give some of our corporate leaders as well. So maybe we can start with Kasper in this case.
Yeah, sure, happy to. I think, I mean, I've seen this with other CVCs previously in my life. It's hard if you start to give up control as a corporation, because the intuition is like, if we control it, it's going to be best. The reality is this is a very specific ecosystem that plays according to very specific rules, and that starts with, like, I mean, over here, just with like simple stuff like Delaware law, and not like the law setup that maybe somebody in Germany is used to. Yeah, and that translates to a lot of things like standard set of terms, standard behavior. Like, I mean, I've seen people, you know, like going around like with blazing guns, promising stuff, and then not executing on those term sheets. Like, you know, like you want to make sure that if you come into this environment and want to be successful, that you find your dedicated mission that you want to accomplish. And this can be different, right? Like we discussed this today. Like, it can be a funnel for M&A. It can be a funnel for business development and actual deals. It can be just a pure VC play that, you know, gives early signals back to the mothership. So there are different ways of how to do this. But ultimately, you gotta play by the rules of the market that you're trying to get into. And if you try to bring your corporate, usually corporates are very good at doing one thing, right? And that made them successful. And assuming that they can take that and introduce it into other things is not necessarily the case, I would say.
That's a great response. Any others want to chime in?
Yeah, I can probably add. First of all, I think don't give up, right? I think that's important because it's a learning journey, right? And as Kasper mentioned, like you have to get used to the environment and learn before you can then get better and better over time. I think the most important piece, in my opinion, is to hire the right talent, or not to hire the right talent, but to bring on board the right talent, right? And for me, but that's also just my personal view again, it should be a mix of people that really have venture ecosystem experience, but then also people that have experience at a corporation, or even best at the corporation that stands behind the CVC, because there is a lot of bridges that you want to build to actually get the support that is actually valuable for you and the startup at the end. So I think having the right talent at the CVC is, in my opinion, super important. And then people talk a lot about very fast processes and things like that. I think, yes, being fast is important, but being transparent and having a clear process is even more important, in my opinion. And I think that's something that is super important if you set up a CVC. Make sure that your processes are streamlined. I'm not saying they should be extremely fast or so, but they should be streamlined and transparent, and you can give actually the companies a transparent timeline and a realistic timeline, because coming back to Kasper's point, I think making promises to startups and then not being able to execute on them might be for the startup very difficult, right? It could even risk the company potentially. So I think those points, in my opinion, there are way more to add, but most important in my opinion.
Great, thank you for that. I have a question from Cristiano from the audience. We just have 3 minutes, probably this might be the last one. So it says, to all panelists, I'm Chris, responsible for new ventures at Telefonica Brazil. Question, how was the process of aligning your corporate strategy with the development of the CVC? What are the best practices to get buy-in at the C level? So maybe Christopher, would you like to address that?
Oh, we're always working on that. That's the thing. Alignment is something that CVCs are always working towards, because, corporations, in many cases, Samsung being one of them, and many other large ones, their strategy is also changing too. So, you always do have to, be flexible in your investment strategies so that they are going to align, very much, but not always the same time, because it's, as I'd mentioned before, you always kind of want to sometimes have a top-down strategy, and where you would be pushing your business units or your overall corporate strategy just a little outside of their comfort zone. Right. So alignment is an important issue, but I don't think there's a really good answer other than you just have to adjust with the changes across the board.
Sounds great. So I think
maybe one
almost...
quick comment. So I think it's important that you have a sponsor or like some backing inside the organization by some high up individual or a group of people. Otherwise, I think it's going to be very difficult if you try to convince an organization from like bottoms up that they need a CVC. That's difficult. Yeah.